Welcome to Your Financial Advocate with Greg DuPont from DuPont Wealth Solutions. As a practicing advisor and attorney, Greg teaches pre-retirees how to reduce debt and taxes and save with less risk so they have more spendable income and plan their way to a better life. Join us for this journey where Greg draws on years of experience and guest experts to help listeners achieve more spendable income for retirement.
Hello and welcome to the Your Financial Advocate podcast. Today's presentation is part 2 of the 2-part presentation based upon a recent webinar that I did regarding the state of the market. First episode that we had here talked about what happened in the market to this point in time. Today, you're going to listen to my presentation about what I expect the future look like. What's the next 6-12 months look like? What are the implications of the financial implications of the political situation, elections, what that all looks like, how it may impact you and your future. So I hope you find this information instructive. If you wish to have access to the slides that we had in the presentation, please feel free to reach out to my team or check us out on the YouTube channel so you can see the video there. Take care. So what's ahead for the second half of 2024? Again, when we look at these numbers, we look at a pooling of market experts. I'm not an economist. I just look for data that they go through. The economy, the dismal science, they call it, right? So if you look at the same economists that the Federal Reserve of Philadelphia used, this is what they're projecting between now and 2025. Midway, call it between now and next summer. Well, the median for growth, GDP, is between 1.5 and 2.4. Unemployment rate, they're looking about 3.7 to 4.2. Core inflation, between 2 and 2.4. So again, these are the numbers that are instructing the Fed on what they're going to do. And these all look like they're pretty good. When I talk about a major market correction, I talk in terms of some form of black swan event that causes it, not a structural, a gradual decline. That's what happened with the dot-com crisis. That's what happened with 9/11. That's what happened with COVID. Things like these happen. Now, as I mentioned before, the market's supposed to reflect the value of the company's earnings going forward, what the market expects that to be. The Fisher market hypothesis says that reflects all known information about the companies. And I also told you that the S&P 500 is really just this approximation chosen by Standard & Poor's to represent what they believe is the top companies in the U.S., which they can put people in, take people out. So that's subject to some manipulation, but that's another story for another day. Here's what I want to share with you today about that. This graph is showing you on the bottom line, what are the earnings of the companies in the S&P 500. The top line is showing you what's the market valuation of the S&P 500. And you see how much of a divergence there is currently from history. How much more overvalued, as I mentioned in that prior slide about the Shiller Price Earnings Index. This is showing you how drastically divergent we are with known profits. And so what this is saying is the expectation of higher profits in the future is significantly higher than has been in the past, at least from that theory. And year to date, there have been stronger earnings reports for most companies than were expected. So there is some basis there for that. I don't know if it's this much basis. As a matter of fact, I believe it's not. I believe when we look about the S&P 500 right now, specifically, it's being driven by what has been called the Magnificent Seven. And by the way, just about every boom season has an equivalence of the Magnificent Seven. These just happen to be the ones that are running the show right now. Microsoft, Apple, Alphabet, Amazon, NVIDIA, Meta, Tesla. And ask yourself, those valuations of those companies at this point in time, is this a baseline that they can grow off of significantly? Or is this maybe a high point that they can come down from? And we're not talking about any particular companies in terms of a recommendation for you, but you need to understand the way this works in your portfolio. Because whether you know it or not, you probably have huge holdings of these companies in your portfolio. And we've seen this again and again and again over time, that the major driving companies, think about GE. GE was the crown prince, and then they collapsed. Think about the big three automotive companies in the 70s. Okay, these things happen. They were the leaders, and they cycle out. So I'm not saying NVIDIA, Microsoft, Apple, blah, 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 is going to crap out now. But there are signs that some of the smart money is starting to rotate their money out of there. But most money managers for consumer investments, they don't have the ability, shall we say, the runway to take some of this money out, because that hurts their performance potentially. Short term. Long term, it may be just what's needed to protect your assets for your life. As this all evolves, this changes. We think specifically about the Microsofts and the Apples in this picture. Well, they're subject to antitrust lawsuits again. You look at Tesla. Tesla's been dropping this year. Okay, so there's some indication that a cycling may happen. And this is why it's very dangerous for us as consumers to focus too much on the S&P as the driver of what we're doing, to focus too much on strictly indexing things. Yeah, low cost is good, and there are times in your journey that it makes sense, and functions in your journey where it makes sense. But not being forward thinking and looking about these changes can really come back to hurt people. So when we look at projected earnings growth, okay, this is, again, the same type of group of experts that are looking at the various sectors of the S&P 500. And right now, they're saying, darn, everything is rosy. The lowest projected growth that they've got for the next year is about 5.5%. Now, we use this information to try to make as good decisions as we can. It's instructive, but we also know that they're wrong quite a bit. We can't ignore the opportunities that are there right now. But depending on where we are on our savings journey, we may need to take prudent steps to put a floor in place. I contend that the selection of the stocks, the selection of the companies, index, whatever, is secondary to having structural integrity on how you've got your money and having a strategy that is going to minimize risk along the way. Okay? Not just ride it out. We've got, at times in our life, we have to take some of the winnings off the table. So when we look at how long inflation will stick around, it does look like they've put the genie back in the bottle pretty good, or at least by the measures that they use. Reasonable minds can say, hey, that's not reality. However, the 2 years of incredible inflation, we know the impact of that. We have seen the reset. We have seen, we used to be able to go to Wendy's for $6 and now it's $10 or whatever, to get a burger and fries. So there's been a reset. And the growth from that reset is not as significant as it was getting there. And I mentioned that in the light of resets in the economy, which is on the market side, what I believe will happen in the next handful of years, if not sooner. A similar reset. Unfortunately, what happens with the market will be a reset down. And then we'll get used to that. And then we can grow off of that. And I'm going to show you in a minute how that historically has been the case. But as we look for the rest of this year, we know that at the end of July, we got the Fed meeting, an opportunity for them to decrease rates, what have you, or hold steady. This will be a major decision point at that point in time, followed by one in September, which is going to get a lot of press because it's right before the election season really heats up, let alone November 6th and 7th, right on the eve. Okay. So these are the points where the Fed is going to have to make a decision. Now, understand structurally, the Fed is an independent entity. It's designed that way to try to be independent of political influence. We'll see. Because what people have to understand is that bond prices and the interest rates or bond yield work inversely. And for many people, that has hurt them significantly over the course of the last few years as interest rates increased. So if I said it once, I said it 100 times. I believe that the bond fund, as it has been implemented in consumer portfolios, is one of the biggest scams the industry has ever had. See, there's only two reasons to buy a bond. One, if you hold to maturity, and the company that you borrowed or that borrowed the money from you, or the government that borrowed the money from you is creditworthy, they'll give you your principal back. And they said they pay an interest rate, a certain amount. If they're creditworthy, they'll pay that. So you have only that risk in there, the credit risk there. When you're in a bond fund, you don't have any guarantee that you'll get your principal back, no guarantee of a rate of return. And the industry has tried to use that as a proxy on your portfolio to protect against the volatility of the equities. And we have seen over and over and over again that on your portfolio, it didn't work that way because they're in funds, not in bonds. If you had in bonds, you had to get out of it. If the interest rates have gone up, then your bonds lose value. Okay, so they're very difficult for people to use in their portfolios. Very easy for large investors, insurance companies, pension funds to do that, to keep them on their books until they're mature. So as long as they're able to hold it until maturity and the companies or governments are creditworthy, then they're good. You, my friend, are not. And that's where the industry has let most consumers down in building their portfolios. Because they've taken this theory that was built for big people holding the money until their maturity and using it for you and I, where we have to get the money out within a reasonable period of time. And so I want to focus on time. Because this conversation differs based upon where you are in your journey. Bear markets and bull markets. Okay? If you are early on in your savings journey, if you hold the money in the market, it will most likely increase over time. That's been proven over and over again. But what people don't understand is there are these long periods of time, a bear market, where the market is flat or even negative. You know, if we look back through eras, we've got just call it the 2010 period of time, where the S&P 500 for that decade was basically flat. And so if you are early on in your savings, well, you're still buying cheap, especially if it's dropped. You're buying things on sale. That's what's called dollar cost averaging. That helps you then. But if you're in that phase of life where you need to use the savings to generate your income in retirement, or you're close to it, then that reduced value and that reduced growth for an extended period of time can have significant impact. So as we're looking here at the end of this year, there's been a sea change because of the interest rates over the last few years. And the sea change has occurred in the insurance industry. You see, who is one of the biggest buyers of these government bonds that have been yielding greater pay? Insurance companies. And so what they have been doing is they have been putting together these portfolios that they can hold for a long period of time and predictably get greater return because they have these bonds that they're holding and they can pool the risk. And so what they've been doing is they have been putting forth solutions for the consumer that give them a greater opportunity to grow with protection than they had been previously. So we've got a lot of clients that are refinancing their retirement, as it were, by taking advantage of outsourcing this risk. So that if there is this extended period of time where we have low growth or no growth, let alone loss, they've got a floor. They have protection. And this is the type of structure that we need to be thinking about. You need to be thinking about if we're young in our savings journey, okay, we got a lot of risk and really the volatility should not really affect us. We're continuing to put money in. But if we're nearing the tail end of our savings journey into our use journey, it's a different story. And so one of the things that we need to be thinking about is, are we in this bubble? Do we have something like that happening right now? Is this going to be a crash? I'm not calling it today, folks. And I'm not saying that AI is a fad. I don't think it's like pets.com. It's a structural change that is going to fundamentally transform our economy when it's implemented. Between that and robotics and energy, all these things, this is why I think is going to be this confluence of factors on the near horizon on top of government policy that causes some real challenges. But it's not here yet. And all of these factors that we've looked at here today are saying to the experts, we need to go along with that to some extent because we know that they are not infallible. But if we go by the body of knowledge that's out there, the rest of this year looks like we're in pretty decent shape. Maybe some volatility along the lines, but it'll be noise. It should be noise, absent any type of black swan event. So separate out the noise, listen to the other noise about the politics, or do as I do. Stay away from the news. Enjoy your life a little bit more. So until next time, I hope you found your time spent with us here today to give you some important perspective on where we are and where we're heading. And as always, if you are a client of ours, please pick up the phone if you got any questions. If you're just a friend of ours that's receiving our information and needs a couple questions answered, please feel free to reach out to us. Take care. Be well. Goodbye.
Thank you for listening to Your Financial Advocate. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of DuPont Wealth Solutions. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.